now for 2 years, Luca, on this initiative, really at its very outset, a gleam in your eye, to come to this pass with the support of the European Commission, of the Parliament, the policy leadership is quite an achievement. My home state of California has established for the last 8 years now the most aggressive greenhouse gas reduction goals on the planet, a 40% reduction in 1990 levels by the year 2030. That commitment holds firm today and was reaffirmed by the governor of my state less than 48 hours after the United States officially announced its exit of COP21. That was accompanied by immediate statements by the CEOs of General Electric, Apple Computer, Ford Motor Company, Dow Chemical, Apple, BlackRock, Goldman Sachs, Disney Corporation, reaffirming their corporate commitment to energy efficiency and renewable energy and greenhouse gas reduction goals. That effort continues apace. And what Luca has asked me to do today is to summarize, not only in the US, but globally, best practices and some key lessons learned in 3 broad areas of green mortgage lending and finance: value, credit, and the loan structure itself. And I'm particularly glad that my colleague Shishiro is here today from Japan. Some of you know that Shishiro was among the co-authors of a report we produced a year and a half ago for Luca, published in Hypostat, which profiled best practices of green lending worldwide. And so I'm happy that Shishiro can cover the tremendous achievements in Japan itself, linked to seismic activity as well, a subject near and dear to my home state in California, as well as yours here in Italy, Luca. I'm really going to speak extemporaneously, and I will put up a few slides, but really want to emphasize some of the key lessons that we've learned in the United States from our practice. We've been at this for 40 years. It really dates back to the first oil crisis in the 1970s. One of the most recent and significant and most intensively studied efforts was the Better Buildings Initiative, part of the 2009 economic stimulus package, which was the first economic initiative adopted by the Obama administration and supported by Congress, which gave $500 million to states and localities throughout the country to experiment with the renovation of homes, both owner-occupied and renter-occupied, for energy efficiency purposes. And what resulted was 75,000 units of housing was renovated. And one of the most important findings is, and this was all third-party validated with home energy assessments pre and post-renovation, is what we call the realization rate, which is one of the key lessons we take from our practice in the United States for bank underwriting and credit underwriting of energy-efficient lending. And by realization rate, we're referring to the difference between the projected energy savings pre-retrofit and the actual experienced savings post-retrofit. And in this particular demonstration, that realization rate was 68%. And we can talk about similar realization rates in the multifamily rental sector as well. Interestingly, and speaking to Adrian's point of transitioning fiscal incentives from grant support to loan and loan guarantee support, when grant support was offered, only 18% of the beneficiaries chose the loan. So obviously, we get better leverage by partnering with the private sector, exactly as EMF and the Covered Bond Council is proposing. In the multifamily side, Fannie Mae has recently dramatically increased its origination of rental housing mortgage-backed securities in its so-called Green Mortgage Initiative. This provides a 10 basis point discount to multifamily rental properties which are certified as green under a LEED or Energy Star label, and or include renovation works to render the property more energy efficient. One of the most interesting characteristics of the Fannie Mae program is a requirement that in order to take the loan and this benefit in the pricing, the borrower promises to report annually energy consumption. One of the great innovations of your model, Luca, as you've heard me say many times, and why I'm so pleased to see Marco from Aon on this panel and in this project, is the direct link between utilities and lenders to measure consumption post-retrofit. Frankly, we really haven't done this in the United States, and it's a big advance, and we haven't had the active participation of utilities such as Aon in the United States. One of the key credit findings in a seminal study sponsored by the University of North Carolina regarding energy-labeled homes and credit risk looked at 71,000 homes, about 35% of which were labeled Energy Star as energy efficient. And very materially, they found a 32% lower probability of default on homes that carried the Energy Star label. Also significant in the US MBS structure, perhaps a little bit less applicable in the covered bond structure, a 25% slower prepayment speed, which provides greater value to the bond investor. These were material findings, they were directly correlated, and they had a direct relationship. The greater the energy label of the house, the lower the probability of default and the slower the prepayment speed. Beyond the Fannie Mae program, we've looked at market rate renovations of rental housing in New York City and Chicago. A very interesting program in Chicago, which is a partner of a bank consortium, which is owned and operated by some of the largest banks in the United States, in collaboration with a nonprofit technical assistance provider, which is a third-party energy validator and provider of technical assistance to small and medium enterprises who serve as the contractors to install these works. This is a loan program to very small property owners. They're only about this tall. No, they own properties of 10 to 24 units. So these are small rental properties. The loan amounts were averaging about $8,000 to $10,000 a door. The payback period was less than 7 years, and the credit and underwriting and pricing of these loans reflected the confidence that the banks had in the repayment history of these loans. A 3% interest rate, a 1.15 debt coverage ratio after renovation was completed, and a 90% loan-to-value ratio certified by an appraisal after completion of the works. This portfolio is spooling out now and is performing as pro forma. It's been quite profitable for the lending consortium. In New York City, a similar demonstration of 40,000 units, almost 300 buildings, found significant savings in fuel oil consumption. In New York City, the principal fuel source, sadly, for space heating is fuel oil, highly energy inefficient and highly polluting. Nearly a 20% reduction in fuel oil consumption under this portfolio. Interestingly, the electricity savings were more modest at 7%. But another key finding of the New York City study, which was co-sponsored by Deutsche Bank, was the realization rate had a wide range from 40 to 80%, showing the difference between projected savings and realized savings. And I think what this demonstrates is that underwriting the realization rates for multifamily rental housing is a bit more complicated and variable than it is for a single-family home. So I think this can help inform the credit decisions of lenders who are taking forth activity in green mortgage lending based on a predicted energy savings. The issues of value have been consistently shown for, 20 years of assessment, with a direct positive correlation between the energy consumption of the home and its value in the marketplace. One of the largest studies in the United States, nearly 2 million units, showed a 9% increase in value for homes which had an energy consumption savings label, either Energy Star, LEED, or some other certificate. The United States Appraisal Institute found that for every $1 in annual energy savings, there was a $20 increase in the value of the property itself. And Pacific Northwest Laboratories operating in Washington and Oregon states, in the Northwest region of the United States, found a very similar correlation when measuring the building's performance against the model energy code that operates in that part of our country, with $140 to $200 or $400 in annual savings, producing increases in value of $6,000 to $12,000 in the unit. Again, speaking to Adrian's point, which I would really endorse, of astute leverage of scarce public resources to partner with private sector capital, which expects a market rate, risk-adjusted rate of return, is the concept of a loan guarantee or insurance fund. And the Danish Energy Agency, along with the Inter-American Development Bank, perhaps you're familiar with this program, together with the Clean Tech Fund and the Global Solutions for Innovative Sustainable Finance here in Europe, is conducting an energy savings insurance program in Mexico and 7 Latin American countries. And this insurance product provides a guarantee against the SME contractor's performance to deliver improvements to the house that will result in actual savings. And in the event that those energy savings are not realized, the insurance policy will pay the bank for having outlaid the additional funds to pay for those works. In addition to that insurance policy, the contractor, the SME, is also agreeing to withhold 10% of their payment on the total contract value for 2 to 4 years to assure performance of the work. It's a little bit like a mini ESCO operation. And the Danish Energy Agency, along with the IADB, projects that this program at scale could generate $10 to $100 billion of lending activity for home renovations and produce scores of metric tons of savings of annual CO2 emissions. The findings for green value in Europe are well understood here, and they're cited by Luke. I don't need to repeat them here. But before I turn to the sort of last point I want to make about the data warehouse, I want to make an argument here that has been touched upon, but I think really bears a very strong emphasis. And that is that this initiative could not come at a better time. Financial regulators and international institutional investors and lenders are becoming increasingly concerned about the discount of real estate collateral that is energy inefficient, the so-called brown discount. So much so to the extent that the Financial Stability Board of the G20 impaneled a financial disclosure for climate risks task force, chaired by former New York City Mayor Michael Bloomberg. That task force, some of you may have read their findings, I don't know, but they've issued their findings and recommendations, and I just want to read one sentence from a key finding. Corporate directors, and I'm quoting from the report, who fail to properly consider and disclose foreseeable climate-related risks to their business could be held personally liable for the operations of their balance sheets. And they go on to state a key concern that bank and insurance balance sheets with real estate impacted by climate change and repricing are at exposure to risk. Now, these words actually aren't just words. They're already being taken up by prudential regulators among the participating states in the G20. So, for example, the Australian Prudential Regulatory Authority in Australia, the principal financial institution regulator, reported significant repricing of carbon-intensive resources and activities and reallocation of capital will be highly sensitive to changes in regulation, technology, physical environment, and behavior by investors and institutions. What does this mean? It means that we cannot afford to do business as usual, that the risk of doing nothing is a potential diminishment, if not collapse, in real estate collateral values of older stock. What is the age of average stock here? The 210 million units in Europe. And we face significant challenges with some of that stock, say in the Soviet era housing stock of Eastern Europe. So your initiative, Luca, I think could not be more timely. The last point you've asked me to speak to is the critical issue of a market rate, risk-adjusted rate of return. How do we adjust for risk? Well, in our financial practice, we do so by understanding the empirical data behind loss. That's really the only way that we can price appropriately. If we don't have the data, our concerns about loss will allow us to lead us to overprice our financial products. In the United States, for 40 years now, we have a comprehensive mortgage data warehouse called the Home Mortgage Disclosure Act. It was adopted in 1976. That tracks not only the origination of every mortgage loan in the country, not only for 1 to 4 unit owner-occupied dwellings, but for 5+ unit rental dwellings, home improvement loans, and mobile home loans. And we do that at a geocoded level down to the census block level, a very, very small geographic area, which allows us to trace gender, income, ethnicity, credit score, loan amount, loan to value, debt to income ratios. We tracked in 2015 14.4 million loan applications and 7.4 million loan approvals, reported by 6,913 financial institutions, all of whom are covered by the financial regulator, the Consumer Financial Protection Bureau in the United States. So while this mortgage data warehouse is quite comprehensive in nature, I commend it to you for its possible use as a model to establish a similar green data mortgage database and warehouse, the kind of template that we spoke about in our meetings over the last 2 days, Marie Louise. And in the remarks that I think have been distributed to participants, citations for all of these resources are referenced for you. So my suggestion is the price of doing nothing is too high, and we really must find a way to renovate our housing stock in partnership with both the public sector and the private mortgage sector. Thank you so much.